Well, I think that's a very good first question, because for an investor, double dip is the key. If you believe there's going to be a double dip, you should be overweight bonds even at these low yield levels and shun equities. If you don't, then equities certainly look attractive at these PE ratios. Our answer to that would be we still think the chances of a double dip are really quite low at this point in time. Historically, there's only ever been one double dip. That was in 1980-81, and that was because of the Volcker shock, the introduction of base money control and sky-high short-term interest rates. Now, to go into a new recession at this point in time, I think you would need to see, firstly, an inverted yield curve, secondly, high real short-term interest rates, third, excessive inventories, and we've just had a big inventory clear out, and fourthly, you would need to see the PMI's leading indicators cross through the 50 line. They may have topped out, but they're a long way from that particular point. So to us, the odds of a real double dip into recession are quite low at this point, thankfully. Yes, certainly. These are the figures, the subjective probabilities attached to the main investment scenarios by our team of global strategists based in New York and London. And we see very much a dichotomy in terms of inflation outlook, with the G7, the OECD area, really facing more of a deflation danger because growth there is sluggish, there is fiscal retrenchment, and inflation is already at very low levels. And the emerging world, where they were less hurt by the global recession, they have bounced back much stronger thanks to the likes of strong domestic growth in China and India, and where they are now much closer to capacity utilization and in some cases are showing signs of incipient inflation pressure. So all in all, in terms of the bigger scale of things, it is a deflationary situation as that is facing the G7 OECD. That is much more of a danger to us for investors than any prospect of early return to inflation. Well, we would say that now with the ECB having to commit to keeping interest rates lower for longer, possibly engaging in quantitative easing, that it's still an outlook in which the euro is more likely to decline. It's stabilized a little bit recently, but the macroeconomic news coming out of Europe over the next 12-18 months will continue to be poor. That means the relative prospects for the US have improved. We don't believe in a double dip for the US, so at some point the Fed will be starting to normalize rates, probably ahead of the ECB. That will be factored into market expectations and should be supportive of the US dollar. The Japanese yen, I think that will continue to strengthen, much to the dismay of the Japanese administration. Basically, I think the relative fundamentals of all the major currencies, none of them are really tremendously attractive. So for us, that means that gold will continue to be like a currency of default and will continue to do well as an asset price.